Hello, in this presentation we will discuss the adjusting entry related to prepaid insurance within QuickBooks Online. We will have a comprehensive QuickBooks Online course soon, if not available yet. We also have a comprehensive Excel course which complements the QuickBooks courses and a QuickBooks Pro desktop version course you can find at the link below. Here we are in the QuickBooks Online dashboard. We will be continuing with the Get Great Guitars problem. We're going to be doing the adjusting process related to insurance here. To discuss that adjusting process, let's go to the reports. We're going to go to reports down here on the left side. We're going to start off with the report of the balance sheet, the financial statement report of the balance sheet, clicking on that item. We're going to be running this report for the 2-month time period of 01/01/21, January 1st, 2021 to 02/28/21. That's going to be the time frame we are working through, January 1st, 2021 to February 28th, 2021, and run that report. Here's the report that we have now. And what we're doing on these adjusting journal entries, so these are going to be the types of journal entries that we're going to make as of the cutoff date, as of the date we make the financial statements, in this case, the end of the month of February 28th. Our goal then is to make the financial statements as correct as possible on an accrual basis as of the cutoff date of February 28th. The prepaid insurance is one of the standard types of adjusting entries we'll have in practice and in textbooks. Remember, when we look at these adjusting entries, we typically have one balance sheet account, this is the balance sheet, and one profit and loss or income statement account. And we typically will not be dealing with cash, which is a bit unusual because when dealing with non-adjusting entries, normal entries in other words, we often deal with cash. So here we're probably not going to be dealing with cash, and we're going to have one balance sheet account, one income statement account. If we look at the balance sheet accounts we're dealing with prepaid insurance. And the income statement account then, as you may have guessed, will be insurance expense. So what we typically do when we set up the system, if we're planning through the system, is we'll tell the accounting department, or if we're the accounting department, we're going to say, we're going to post any insurance payments to not insurance expense, meaning we're going to credit cash, and debit, or the other account, will be not insurance expense, but prepaid insurance, an asset account, not a profit and loss, not an income statement, not a deduction of net income account. And the reason for that is that prepaid insurance will be something that we pay for before we get the consumption of the insurance, before we use the insurance policy. And typically a lot of businesses will pay significantly in advance, meaning 6 months in advance to a year in advance. And therefore, if we write off that whole payment in the time that the payment is made, it could significantly impact the financial statement correctness, because really we should be allocating the expense on a monthly basis as we're consuming the insurance rather than when we paid for it. Now, if we had recorded this as an expense, then we'd have to do like the reverse of the adjusting entry we will do here, meaning we would make some of it prepaid as opposed to having the whole $11,000 written off whenever we wrote the payment off in. So here we're typically, if we can plan it first then and plan for the adjusting process, we're going to say, hey, put it into prepaid insurance, and at the end of the month or the end of the year, we'll just fix it to make it whatever it should be by doing this adjusting entry. So what we're going to say here is that if we click on this prepaid insurance, and see the check was written. Here it's a check that was written for $11,000. If we select that check, then we can see the check. And here's the actual check. Now we're going to assume that this check was written for an entire year's worth of insurance. So we'd have to look at the policy, of course, to determine that. We're going to say this is a year's worth of insurance. I'm going to close this back out. We're going to go back to the report. And so what we're going to say now is that there has been 1 month has passed since we purchased this insurance, meaning we consumed 1 month. So it's a fairly simplistic calculation. We're going to say that we're just going to say that there's $11,000 that we paid for 12 months. Now 1 month has passed, and therefore no longer 1 month's worth of that is an asset, and 1 month has been expended. So we'll take that and divide it by 12. And that's going to give us the 916.66. This will be, and we're just going to round it to 917. So this is going to be the journal entry we will do. What we're going to do is we're going to say that this needs to go down by 1 month, which is 917, and that the related expense account needs to go up by the 917 for the month of February, and therefore bring net income down by 917. That is the transaction we will do now. Typically, we would do this by selecting the plus arrow down here. So it's a plus icon, not really an arrow. We're going to select the plus that changes to an X. And typically, we would do a journal entry here because it's an adjusting journal entry. And typically, all journal entries are done with the journal entry. But there's only 2 accounts affected here. So we're actually going to try to use a different process so that we do not need the debits and credits. We're going to use the registers if there's only 2 accounts just because we can. And then when we go back in here, we'll see that QuickBooks still created a journal entry, but we can do this with registers. So if we were to do the journal entry, as we'll see when we get back into the journal entry, we'll debit the expense by 917 and credit the prepaid insurance by 917, bringing the prepaid down, bringing the expense up, and reducing net income by the expense amount. But we're going to do that with the registers. So we're going to close this back out and attempt not to know the debits and credits as much, or is to use the registers. And if you are good with debits and credits, then the attempt is to better understand the system here so that we can see multiple ways to enter this information. So then we're going to go to the accounting on the left side. And we are in the chart of accounts here, the first tab on top. Typically, when we look at the register, we think of the check register. But any account that's a balance sheet account will typically have a register. We're dealing with 2 accounts here, insurance expense, which is an income statement account, and therefore not a balance sheet account, may not have a register. And then the other account we're going to be dealing with will be the prepaid insurance. So we're going to look for the prepaid insurance, which is going to be an asset. It's in order. Assets, liability, equity, income, and expense. Assets then being checking, accounts receivable, and then inventory, prepaid expenses. Here we go. That's what we want. We want the prepaid expenses, other current assets. This is the one. That's the one. So it's got 11,000 in it, as we saw on the balance sheet. We're going to select the register and work with this item. So there's the 11,000. We're going to create a new item here. It's not going to be a deposit, not a sales receipt, not a received payment, no refund, no transfer, no. We have to use journal. So it's going to be a journal entry, even though it's not going to look like the journal entry we just looked at. So it's going to be a journal entry, however. So all adjusting journal entries will be as of the end of the month, as of the cutoff date, which in this case is 02/28/21, February 28th, 2021. The payee, I'm not going to put a payee. The memo, it's going to be an adjusting entry. And I got a few capitals there that are probably unnecessary, or most definitely are unnecessary. And then we're going to say that we are going to decrease it because it's 11,000 increase, and we're going to make it go down by that month's worth that has been consumed, and therefore should not be included anymore in there in the prepaid amount. So there's that. The other side is going to be insurance expense. We could select the drop down and find it, and or type in insurance, and then it's going to be the expense over here in the type of account. So it's insurance and expense in the type. So we're going to say okay, and we'll save that item. And there we have it. So it should be saved. Here it is. So now we're going to go back to our reports and see if it does what we believe it should do, which is to bring down prepaid insurance by the 917, representing 11 months still there, and then go up on the expense side for insurance, bringing down net income. Reports, left side. We're going to go to the balance sheet report under the reports, and we're going to change those date ranges once again to 01/21 to 02/28/21. That's February 1st, 2021. I'm sorry, that's January 1st, 2021 to February 28th, 2021, and run that report. So here is the report. We're going to scroll down to the assets section for the inventory assets. Not inventory, prepaid insurance assets. There it is. We have 10,883 in it. And that should be 11 months now. So we're saying that if we took the original 11,000 divided by 12, because that's for a full year and we want to see how much it is per month, that would be 9/16. We used 9/17. We rounded to 9/17. And there's 11 months left that have not yet passed and therefore are prepaid and, in that sense, an asset, something we're going to consume in the future. If we take that 9/17 and multiply it times the 11 months that are still remaining, we get 10,087, which is close to the 10,083. It's off by the rounding because we rounded up by to the 9/17 rather than having the pennies there. So let's take a look at it. If we drill down on the prepaid insurance, then we'll see that 11,000 here. And then we see our adjustment for 9/17, leaving us with the prepaid amount of the 10,083. If we select this 9/17, which is, note, a journal entry, even though we entered it into the register, it's an adjusting entry here, and we select that item, we see not the register, but an adjusting journal entry in a journal entry form. We see the debits and credits. So this is the form, this is the default form that QuickBooks has to go to because there's no other document that it's going to be used. There's no bill, there's no invoice. It has to use a journal. QuickBooks wants some type of form, some type of journal as the last scenario if there's no other form. Also note that the way we entered it into the register, because we used the prepaid account, it said that we decreased that first. We did that first because we used that register. That's the way QuickBooks sees it. And therefore, QuickBooks put the credit on top, which again, if you're an accountant student, then you're probably, that may look funny to you because you always think that the debit should be on the other side. And note that that's just a convention, really. And usually the software does that. It makes you kind of put the debits on top, usually when we make journal entries or look at the GL. But it's not something that always happens, and it kind of depends on the software as to what's going on and when the debits will go on top. This one, because we used the register in the format that we did, they put the credit on top. And note, it's just a convention, and it doesn't matter which one goes on top, the debit or the credit, as long as they're in the debit and credit columns. So we're going to close that back out, and we'll take a look at the other side, which will be on the income statement or profit and loss. So we're going to go to the reports on the left side, and we're going to select the profit and loss report. We're looking for the profit and loss report, and then we're going to run that for the 2-month time period once again, which is going to be 01/01/212/02/28/21. That's January 1st, 2021 to February 28th, 2021, and run that report. So here we have the report here. We're going down to the expenses area where we have the insurance expense. Here's the insurance expense. It's got $917 in it, which was 1 month's worth of expense. That, of course, increasing the total expenses and therefore decreasing the net income. This is important to note on these adjusting entries. Note that oftentimes, as you'll see if you're in public accounting, you'll end up making the net income a lot lower than it was originally when you got the work because of these adjusting journal entries, and so it can be significant here when we go through this process, because it typically does end up reducing the net income, oftentimes making the books look worse than they originally were when they brought it. But they have to be done because, of course, this is part of the process. So that 9/17 was consumed and therefore is an expense in bringing down net income. If we select that insurance item, then we can go down here and we can see that 917th. If we select that item, once again, we will then see our journal entry that was generated when we enter this information into the register for prepaid insurance.